people want to go back and watch our interviews in late December of last year, early January, one of my targets was 2,500 on gold. I did say it would be the best performing asset. I think Bitcoin still has it beaten for now. We'll see if that's the case. But I think gold has outperformed the S&P at this point for the year. But the key here is that ultimately the upside has come through. The dollar has weakened. The Fed has gotten closer to cutting rates. The central banks have been buying gold hand over fist, which always is a great indicator, right? These are the guys that print the money. So chances are, if they're buying gold, we all have to be following them.
Gold appeals to central bank reserve managers as a safe haven in periods of economic, financial, and geopolitical volatility, says a research paper co-written by monetary historian Barry Eichengreen in 2023 and published by the IMF. So far this year, gold has surged by about 22%, surpassing $2,500 an ounce, driven by geopolitical uncertainty and expectations of a potential Federal Reserve interest rate cut. In comparison, the S&P 500 has risen by around 18.5% during the same period. Renowned financial analyst Gareth Soloway notes that the dollar's weakness has been crucial in recent market shifts, with gold outperforming the S&P 500 despite Bitcoin's lead. He emphasizes that central banks' gold purchases signal the asset's strong future potential. Demand for gold from central banks has been elevated in the last 2 years as some countries diversify their foreign currency reserves. Their demand contributed to the gold price rally in March to May, with the spot price hitting a record high of $2,449.89 per ounce on May 20th. From a technical perspective, Soloway predicts that rising U.S. government debt will worsen in a recession, prompting more government spending and easier Fed policies to boost gold. U.S. total public debt has increased every year except 2000. When it decreased by almost 2%. Market observers say concern about the rapidly rising U.S. government debt is partly behind recent gold prices and Bitcoin surges, even as the Treasury market remains relatively optimistic about the country's fiscal path. By analyzing the logarithmic chart, Soloway shares his next upside target for gold, which is around $2,700, connecting the highs from 1979 to 2011. The RS1 index indicates that gold is overbought, showing above 70, suggesting a pullback in gold to around $2,350 due to weakening momentum. Now we present the clips of Gareth Soloway's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
So the dollar breakdown has been a key influential part of this. It's a safety asset. We know central banks, and this is something, by the way, if people want to go back and watch our interviews in late December of last year, early January, one of my targets was 2,500 on gold. I did say it would be the best performing asset. I think Bitcoin still has it beaten for now. We'll see if that's the case. But I think gold has outperformed the S&P at this point for the year. But the key here is that ultimately the upside has come through. The dollar has weakened. The Fed has gotten closer to cutting rates. The central banks have been buying gold hand over fist, which always is a great indicator, right? These are the guys that print the money. So chances are, if they're buying gold, we all have to be following them. And I think also you look at like the price action here, and it's very emblematic of the market and investors saying we don't trust a U.S. debt that just keeps going up, even in an expansionary period, right? And not to get off track here, but with 35 trillion in debt at the U.S. government level, we know that essentially, generally, debts are supposed to be paid down during expansions, and then during recessions, the government comes out and spends more and runs up debt. Well, it's been the opposite, and it's only going to get worse if we do go into a recession. The government will spend more, the Fed will loosen monetary policy, and that's very bullish for gold. So again, any asset, palladium, platinum, I like them all, as long as they're precious in that sense, they're relatively rare, and I think gold goes ultimately higher. I mean, I still expect pullbacks on gold, but I think you buy the pullbacks at this point. In fact, I'll show you guys my next upside target on gold here. And that upside target is found by going to the logarithmic chart on gold. And if we zoom out, this is pretty remarkable here, guys. We're going to zoom out all the way to the 1970s, and we're going to take the high from 1979. We're going to connect it through the high from 2011. And what this tells us is we should see upside to somewhere around 2675, 2660. That should be our next target. Now, I'm not going to say by year end. That's a little too, I've already hit my year end target, so I'm going to rest on those laurels. But ultimately, by early 2025, I do think we're at 2660 on gold. There are, in all fairness, I mean, we could just pop up. Let me flip back to my my regular chart. So we get rid of the logarithmic here. But yeah, if you just go to things like relative strength index, there's no doubt that we're kind of in the upper range here. Relative strength index above 70 tells you you're overbought. There's also a negative divergence here. So to me, this is one of the reasons why with my swing traders in my commodity service, I've unloaded our gold position, because in the short term as swing traders, I do think it's going to pull back. So for those of you that don't understand positive or negative divergence, just to give you guys an awesome educational crash course, when price goes up, RSI should be going up, right? When RSI has a high and a lower high, but price has a high and a higher high, that's called a negative divergence. That means price is beginning to get weak for the chart in question, in this case, gold. And so my guess is gold does have a pullback coming. And if we go back to the daily chart, the pullback for me would simply be to the lower end of the parallel channel here. If we put this in and we drag this down, it would basically be back to about 2350. So a pullback to 2350, I would buy though.
Regarding the Fed's actions, Gareth Soloway underscores that markets often decline when rate cuts begin, signaling the Fed is behind the curve. He predicts more cuts, but warns that the Fed's dovish stance may reflect troubling economic data. Soloway advises caution, as significant cuts could indicate more profound issues. Traders have fully priced in a Fed easing for next month, with a 70% chance of a 25 basis point cut and about 30% chance of a bigger 50 basis point reduction, according to the CME FedWatch tool. Gold prices rose on Tuesday, driven by a weaker dollar. Investors are awaiting inflation data that might provide insights on the scale of the Federal Reserve's expected interest rate cut next month. Despite rate cuts in 2008, the market plunged. Soloway anticipates that aggressive Fed rate cuts will likely signal serious economic trouble, potentially leading to a major recession and significantly lower earnings due to struggling consumers. Let's get back to the interview.
Historically, when the Fed actually starts cutting rates, that's when markets tend to roll over. The reason that happens is because almost always the Fed is looked at as being too late to the punch, right? They start cutting, but they're not cutting fast enough for what the market wants. So we'll see what they do in September. There's going to be a rate cut. The question is it 25 basis points? Is it 50? How do they guide the rest of the year? One thing I would point out is, number one, the dollar has broken down. So if we look at the DXY chart here, there was a classic wedge pattern, and the dollar has now broken this. And what this tells me is the dollar is going a lot lower, which means the economy is likely going to get much weaker than we expect, forcing the Fed to cut even more. Because the more the Fed cuts, the weaker the dollar in general gets, especially against a basket of other currencies like it is. So that's number one. And we can also see that the 10-year yield has also had a big breakdown here and is likely headed to a major target range of 3.3 to 3.2%. So you can see trend line right through these lows. And then this one's a beauty, upsloping, and both of these lines meet. So this tells us that yields are going to go lower. The only reason yields are going to go lower is if the Fed has to cut quite a bit. Now, the market, you would say, well, wouldn't the market love that? Well, the market would love that if the Fed was doing it for other reasons than the economy was collapsing. And I would just like to point this out. We were just discussing this before we went live, was that the Fed was unbelievably dovish. Their minutes last week that came out, they talked about a July rate cut. That was surprising to me. Then Jerome Powell at Jackson Hole, he was unbelievably dovish, saying the time has come. We're going to cut multiple times. What struck me, and the markets rallied, right? On Jackson Hole, we saw Friday, the markets were up. But what struck me was that he was so dovish, and the other members are already talking about rate cuts that could have happened at July. What are they hiding? What are they not telling us that they're seeing? Because if you look at the jobs numbers, I mean, yeah, we're weakening, but is it really weak enough to denote a rate cut in July potentially that they didn't do, but they talked about it seriously, and all of these coming up? So I would just throw this out to investors, is be really careful. This is telling me the way the Fed is talking is that they see data that is concerning them, whether it's in the financial system or in the economy, that is making them say, we got to cut, and we got to cut quite a bit. Historically, when you get these downturns, right, I think about when the Fed was cutting rates in 2008, right? The markets did not rally in 2008. We know it had a massive move down.
Yeah.
You could go to almost any other period where the Fed was cutting rates aggressively. And the reason they're cutting rates aggressively is not because, the economy is still good and all, because keep in mind, if they cut rates too much and pump too much money into the system, what's going to happen? Inflation's going to roar back. So the only reason they're going to cut rates is if inflation is under wraps. deflation potentially, which could be on the cusp, meaning that we are in a major recession on the horizon. So I would dare say that the cuts, if the Fed is going to cut aggressively, it's telling us the economy is in shambles. And that, again, is not good for stocks because you have the consumer, which, by the way, we've already seen the consumer struggling with many earnings reports from companies saying this. And if the consumer continues to struggle, it means earnings multiples, earnings essentially come down quite substantially.
Analysts at Citigroup Incorporation suggest that, with looser monetary policy and a possible increase in volatility due to recession risks, gold could reach $3,000 by mid-2025. How do you think the economic challenges and anticipated rate cuts will impact the future of gold and other safe haven assets? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.